So recently I got into a very hot contested debate with a friend of mine over the issue of Tesla Motors. Now this friend of mine, he's actually introduced to the company through me. I knew it back when Martin Eberhard, no, Elon Musk did not found Tesla. And I knew it in its early infancy when they were now developing the Roadster with Lotus and other things, and before Elon actually ousted Eberhard and they had the lawsuit and stuff like that. But me and my friend were getting into the discussion. I basically said, well, I'm not hugely optimistic. I'm hopeful, but not hugely optimistic about the prospects of the company. And my friend, who is a true believer in Elon Musk and believes he's the smartest man on the planet for some reason, he and I got into it, and I basically said, "Well, look, the numbers don't lie. They're bleeding cash. They're not making a profit." And he would come back and retort and stuff like that. So I'm gonna walk through a couple of the financials, show you the problem. You could decide for yourself. I'm not invested in Tesla. I have no stake in Tesla at this point. I probably should take on a short position, but at this point, I'm not doing anything like that. I'm just using this as an example of some of the fundamental analysis that I look at when I'm evaluating a company. So with that said, let's take a look at the income, the balance sheet, and the cash flow, and quickly at the 10K to basically see what is the state of the company and why potentially it seems like they might be on the skids. As we know, Moody's has just downgraded the bonds. The bond yields are going down. Their interest payments seems to be going up. So there are a lot of things that we need to look at. So with that said, let's take a quick look at the income, balance sheet, and cash flow statements. Okay, guys, this is NASDAQ.com. For those of you who know, I run a small long-short U.S. equities currency and option fund. I'm presently not invested in Tesla, so I don't have any conflict of interest. I have considered taking a short position, but not presently. And this is the income statement for Tesla. Now, my friend who was very kind to pull up the financials basically said, well, look, this is the number that they're all screaming and hollering about as their cheerleaders, which is the gross profit number. So as we can see from 2014 to 2017, yes, it looks like the money, the profits that Tesla's been making have been increasing. However, you never look at this kind of information in a vacuum. And in fact, there are a couple of things that the cost of revenue that are normally included in the cost of revenue that for some reason Tesla does not include. They actually pull it out in order to make this number look a little better. So we're never, I mean, it's good to see gross profits increasing, but that is not the most important factor. So just to make a note of it, let's just take a quick look at the research and development costs for Tesla. As we see it, it's laid out here. And if you were to compare the income statement to a company like the Ford Motor Company, which is the symbol here, F, right? Well, it's Ford is yeah, so they have leasing, so that's why it's considered a financial company. But this is Ford. This is the car company. We see something. So here we go. Research and development. There is nothing in the research and development. Of course, there is research and development going on, but that cost, if you read the 10K, has been included in the cost of revenues, right? Which Tesla pulls out. Again, if we look at GM, this is General Motors, and we see here the same thing as before, research and development, right? 000 from 2014 to 17. Why? Because the research and development cost is included in the cost of revenue. And so Tesla's, I mean, I think maybe Fiat Chrysler, I don't know the symbol for them offhand, they might show it separately, but it's just very interesting that they make that distinction. And the reason is, of course, is to make this number here look good. But as I keep telling my friend, that is not the most important number when you're looking at the financial statement. It should be noted that the sales, general, and administration cost has ballooned by over $1 billion. So yes, I understand they're taking on staff and all these other things, but this is quite concerning. I would probably want to see some of the compensation packages and stuff like that, given how much this has ballooned in such a short period of time. But then further on, there's also the interest expenses. So as we know, Tesla's been raising money through shares and through notes, bonds, and other things like that. This is a very high interest payment. I say we just look at it in terms of a percentage the earnings and stuff like that, this is nearly $500 million in financing. That's just interests back to the shareholders. So this has ballooned tremendously from the previous years. So I mean, it's more than doubled in that very short period of time. And you keep in mind that I think in 2015 is when they actually bought Solar City, when with stock and assumed debt. So they took on a lot of debt at that time as well. But this figure is quite concerning. And at the end of the day, their total net income, this is actually what really counts, is close to a loss of $2 billion. So with that said, let's take a quick look at the balance sheet, and we'll do some more analysis there. Okay, guys, so we're still on Nasdaq.com. We're looking at Tesla. This is the balance sheet. And let me just show you the concern as going forward. So this is cash and cash equivalents. They basically got about $3.5 billion in cash. I know some of this is held in currencies around the world. Net receivables, this is usually down payments or people who purchase maybe battery packs and other things. Inventory must be the cars. I'm not sure what the current liabilities are. But all in all, that their total current assets, let's just say $6.6 billion. So for the next 12 months, they're supposed to have access to at least $6.5 billion if nothing tends to improve. But here is the concern. When we go down to the current liabilities, now the current liabilities are the liabilities that they need to pay usually within the next 12 months. Or for at least the next fiscal year. And sometimes it's a little bit more, sometimes a little bit less. But it usually these payments come out within the fiscal year. And this is a real concern. So accounts payable, could be suppliers, raw materials, other things, short-term debt, current portion of long-term debt. So this could be interest and principal payments, some of it going to long-term, some of it is going to shareholders and other things like that. Other current liabilities. This is the number that's concerning, the total current liabilities. And we see here it is let's say $7.7 billion. Now, when we contrast this number with this number, we see that there's a huge shortfall. Now, to be fair, yes, Tesla has had an issue with shortfalls in the past. So if we look at 2014, they had, about $2 billion worth, but they had access to $3 billion worth of capital over the course of the year. Then they had a shortfall in 2015 by just about $100 million. And then again in 2016, you could see that they were actually kind of in the green. People thought this was turning around. That looks like about a spread difference of maybe half $500 million, give or take. But now we've got this huge gap of close to, let's say $1 billion. That's pretty substantial. And this is what people are kind of noticing. So, I mean, how they've been doing it, of course, has been through, common stocks, and I'm not seeing it here. But yeah, this is the concern. This is why, the debt equity ratios are being skewed because they're taking on more and more debt. Their interest rates of payments are going up, and as it seems to show in the numbers, they literally do not have enough money to pay all of these short-term debts. Now, I know some of it could be converted, and there's share options, and they can extend and stuff. So I'm not too concerned about the next 12 months. However, if the circumstances don't change, which is why everybody's looking at the production numbers, they could have some real problems trying to raise financing and convincing investors that the company is viable in the long term. So so with that, let's take a quick look at the cash flow, and I will point out the most important number that we need to look at. Okay, guys, still Nasdaq.com. We're looking at Tesla Motors, and we're looking at their cash flow statement. And contrary to what my friend was saying, this is the number that matters, the net income. And as we see, tremendously, they have lost more money from 2016 to 2017. So there was a loss in 2016, but this number has ballooned to over $2 billion in losses. And this again is, the actual operations, the running, the interest, the investment, everything cumulated. Their productivity gave them a loss of $2 billion US dollars. So that's not a very good sign. Now, a lot of people say, well, it's all right. Back in the day, Amazon.com, back in the dot-com era, wasn't making any money. They weren't making any profits. And look, they're still around today. Well, there are two problems with that. Firstly, Amazon has practically, at least in their early business model, had practically no infrastructure. They were not a capital intensive business. And through their freestanding, free-flowing cash flow, they were able to finance their operations. So anybody who's used Amazon knows we pay them up front, whatever the cost of the book, movie, whatever the case might be, and then they might trickle out and pay their suppliers up to 30, maybe up to 3 months or however much longer after the fact. And that spread allowed them to basically finance their entire operation on a shoestring. Tesla, however, is a capital-intensive manufacturing company. There is no comparison, right? At the end of the day, one basically was able to self-finance. Tesla is unable to do that. And we see it right here. So again, cash changes in operating activities. Right. So the net income is, as we see, nearly 2 billion. So this is after all of the depreciation and the accounting and income and other things. They're still making a loss of 60 million dollars on it. So their operations are actually not producing the cash that they would like. Cash flow from investments, again, this could be property and other types of things that they've spent. They're not making any cash here. And this is basically where all their money is coming from, which is financing. So they've been selling shares, they've been borrowing more money, and this is basically the 4 billion is basically what's keeping them afloat. So Amazon.com was cash heavy here at the net cash flow from operations. They were cash flow positive from very early on. Unfortunately, Tesla, in the case of Tesla, they're cash heavy from borrowing and investments. So the business models are not the same. It's definitely not a streamlined and efficient online e-business. This is a car manufacturing company. Yes, and they've got energy products and the solar panels and all this other kinds of stuff. And it's a real problem. And given the recent downgrade by Moody's on the bonds, the yields, so the interest that people are getting for these bonds has actually gone up. So before I showed you this number, let me just show it to you again, I think. Yeah, so interest expense, right? So this was at the end of last year. Right. So the interest expense, so this was the end of last year. But, what the hell? But because of Moody's downgrade, I understand, I have to work the numbers. This number has basically come up to 1/3 of what this number is, which means this is getting even smaller and smaller, even if you don't want to include the research and development. This number is virtually disappearing. And a bulk of it, 1/3 of it, is simply interest payments and interest repayments because of the Moody downgrade. So the company is not in great shape. As I say, I think even if we take a quick look at the 10K, the annual report, they themselves make that statement pretty well known. So let's take a quick look at that, and I'll just give my final thoughts and close out the video. Okay, guys, this is the 10K or the annual report for Tesla, and as you can see, it's for the last quarter of 2017. So I just want to jump down quickly to the financing and liquidity option and show you their statement. Okay, guys, so this is under the liquidity and capital resources. I just want to point this statement out really quick so you can see it. They basically said that they've got enough liquidity for the next 12 months. And we've seen in the balance sheet, they've got cash equivalents and cash up, inventory and other things. If everything goes well, about $6.5 billion. Although the current liabilities for the year include close to $7 billion. I think it was $7.2 billion. I can't remember the exact figure. So, I mean, they could renegotiate some of that, convert some of it to bonds, to stocks, equity. They can make it work. But this is the statement that my friend didn't quite understand. We may need or want to raise additional funds in the future, and these funds may not be available to us when we need or want them or at all. If we cannot raise additional funds when we need or want them, our operations and prospects could be negatively affected. In other words, if they can't raise the gap difference and find other ways of financing, either self-financing through the sale of the Model S and X and the Model 3, or through raising funds from the equity and debt markets, which is more bonds, notes, and shares, they're basically going to go out of business because just systemically, the amount of money that they're burning, there is not enough cash coming in to maintain the operations. And the problem is, it looks like the debt market is pretty much kind of closed off to them at this point. Issuing more shares, you can get shareholders that aren't too pleased with that. I think they're already in some trouble regarding the purchase of Solar City. So not to mention that there looks like the NTSB, which is like the highway safety guys in the US, are investigating a crash. There are a couple of things that are definitely concerning. Now, I'm not saying they're going out of business. I'm not saying they're bankrupt. I'm just saying they've got a very rough road ahead. And I believe in electric cars. I'm a very big supporter of the technology. I don't like particularly the government subsidies and relying on bailouts and other things like that. But nonetheless, the numbers don't lie, and they don't necessarily add up. I haven't even gotten into some of the analysis. The other analysis I do, like the DuPont analysis, to really look at the margins and other things. Just from the basics, anybody reading these statements would definitely be scratching their heads. So again, guys, that's my video. If you disagree with me, that's fine. As I say, I'm not part of the cult of Elon. I think a lot of his ideas are pretty ridiculous. But nonetheless, you're free to disagree with me. At the same time, be sure to like, share, and subscribe if you'd like to see more. And connect with me on social media, and we can definitely have the discussion. So, as always, thanks for watching, guys. Take care. Bye-bye.